The Property Bulletin by London Property, the home of superprime.
In her scramble to plug what she says is a £50 billion black hole in the public finances, Chancellor Rachel Reeves is reportedly weighing up a series of new property tax measures, and middle-class homeowners could find themselves firmly in the crosshairs. Labour has already squeezed non-doms, pensioners, private schools and employers. Now the Treasury is said to be exploring what critics call a tax raid on the nation's homes. Among the options, scrapping stamp duty altogether and replacing it with an annual property levy. Left-wing think tanks suggest charging 0.54% on homes worth over £500,000, rising to nearly 1% for homes above £1 million. That would mean a £1.5 million property facing an annual bill of around £9,500. Another possibility is extending capital gains tax to so-called high-value main residences. This would be a fundamental break from Britain's tradition of shielding the family home from such levies. Analysts warn this could gum up the housing market, deter sales and ultimately raise little money. There's also talks of a full council tax overhaul. Current bans are still based on 1991 values. Updating bans or replacing council tax with a flat property tax would massively increase costs for homeowners in high-value areas, especially London and the South East. Some advisors are even dusting off the idea of a land value tax, taxing the ground beneath a property rather than the building itself. Some claim this would redistribute wealth more fairly, but economists point out it would be complex to introduce and would risk destabilising the market if rushed. And finally, the Treasury is thought to be eyeing inheritance tax reliefs. At present, couples can pass on up to £1 million tax-free, including their main home. Removing that so-called residence allowance could drag 30,000 more families into inheritance tax each year, raising £2 billion, but leaving many grieving households facing bills of £70,000 or more. Critics warn these ideas could be politically toxic. The English, they say, have a deep-rooted attachment to home ownership, and taxing the family home, whether through an annual levy, capital gains or inheritance reform, risks a public backlash. Some even describe the mix of proposals as a lethal cocktail that could devastate Labour at the ballot box. For now, no decisions have been made, but with the budget approaching, one thing is clear. Rachel Reeves has her sights firmly set on property as a potential cash cow. The question is, at what political cost? The UK is on the verge of a big legal shift for crypto and blockchain. The Property, Digital Assets, etc. bill is moving through Parliament and is expected to become law soon. So what's changing? For the first time, the law will formally recognise digital assets, like cryptocurrencies and stablecoins, as a new category of property. Up to now, assets were classified either as physical things or as rights, but digital tokens never quite fit. This bill creates a third category, giving them clearer legal status. Why does this matter? Businesses using blockchain can now treat crypto as legally recognised property, reducing uncertainty around ownership and disputes. Contracts can more easily include digital assets, for example, using crypto as collateral in loans. Fintech and blockchain firms may feel more confident building tokenised products, smart contracts and cross-border tools. And for the crypto sector, legal recognition could encourage institutional investors and deepen links with mainstream finance. The bill is also designed to be flexible. Courts will develop the details case by case, helping the law keep up with technology. This sits alongside other UK initiatives like the Digital Securities Sandbox, stablecoin regulation, and even early planning for a digital pound. Some lawyers say the bill simply formalises what courts have already been doing, recognising crypto as property in practice. But the bigger picture is clear. The UK wants to be a global hub for digital finance, and this legislation provides the legal certainty businesses and investors have been waiting for. London's super-rich are ditching buying and turning to ultra-luxury rentals, with some homes now letting for as much as £325,000 a month. Why? 2 words: tax changes. Stamp duty can now hit nearly 20% on high-value homes, while Chancellor Rachel Reeves has abolished non-dom tax status. For wealthy families, that means owning in London could trigger tax on their worldwide income. Renting, however, avoids stamp duty entirely and keeps them flexible. The numbers tell the story. In the first half of this year, there were 1,588 rental deals above £1,000 per week, more than double last year's figure. Landlords collected almost £83 million from this slice of the market, according to Beecham Estates. The deals themselves are staggering. A Mayfair mansion near Berkeley Square went for £75,000 a week. That's £325,000 a month. Another in Marylebone rented for £28,000 a week. Demand stretches across Mayfair, Belgravia, Knightsbridge and St John's Wood, with properties boasting pools, cinemas, spas and even classic car garages. The new wave of renters isn't just British non-doms. It includes wealthy Americans, Gulf state royals, successful Israelis and affluent Chinese families who once bought but now prefer to rent. Agents say mobility is the new currency of wealth. Billionaires want bases in multiple countries without tying themselves down. Renting delivers that, while avoiding stamp duty, service charges and exposure to London's softening sales market. It's not just London. In the Cotswolds, American tech billionaires and film stars are paying up to £95,000 a week for staffed country estates with helipads, pools and banquet halls. The shift is reshaping the market. Fewer £15 million plus homes are selling, but the luxury letting sector is booming. Developments that once struggled to sell, like 60 Curzon in Mayfair, are thriving by switching to high-end rentals. The message is clear. The wealthy still want London and the English countryside, just not the tax bills that come with ownership. Renting, even at eye-watering levels, is the smarter play. The UK government has published draft legislation for its new carried interest regime, due to take effect from April 2026, and it could have a big impact on real estate and real estate credit funds. Here's the headline. From 2026, all carried interest will be taxed as trading income at rates up to 47%. But if the carried interest qualifies under new rules, only part of it is taxed, giving an effective rate of about 34.1%. That could mean lower tax bills for executives in funds focused on income-based returns like rent or interest, which under today's system were often taxed at the full 45% income tax rate. So what makes carried interest qualifying? The fund must hold its assets for an average of at least 40 months, known as the new AHP rules. The rules have been updated to make them more realistic for property funds, treating later investments or debt restructurings as part of the original holding period. Importantly, the definition of major interest in land has been expanded to cover non-UK property as well as UK land. For real estate funds, this means bolt-on acquisitions or partial disposals won't automatically shorten holding periods, making it easier to qualify for the lower tax rate. For real estate credit funds, the new regime is also far more accommodating. Large loans and related investments will now be grouped together for AHP purposes, and even early loan repayments can sometimes still be treated as long-term holdings. Of course, there are trade-offs. Because carried interest will be taxed as trading profit, fund executives will fall within the UK's payment on account system, creating potential cash flow headaches, as carried interest is famously lumpy and unpredictable. Overall, the changes bring corporate funds and employees into scope for the first time, but they also create a clearer and in many cases fairer framework. For some in real estate-based strategies, a flat rate of 34.1% could actually mean a reduction compared to the current blended rates they face today. The bottom line. This is a major shift for property and credit funds. The regime is broader, more inclusive, but also potentially more predictable. And executives will need to get to grips with the 40-month holding rules well ahead of April 2026.
Subscribe to our newsletter to receive our weekly bulletins and stay ahead of what's shaping the super prime property market.